Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. I'm also going to show you a really interesting section of the market which is just shaping up now, so make sure you stick around for that. As always, this is general commentary. It doesn't take your personal situation into account. With all that said, let's jump over to our first chart. And I've got the S&P 500 up on the screen. And this really has been an extraordinary run from the October low. And I just want to put this into perspective. It's been the S&P 500 from that October low, it's been up 14 out of 15 weeks. And the last time that happened was way back in 1972. As far as I understand it, that's how long you have to go back to get another sequence of 15 up weeks or 14 up weeks out of 15. Now I've said that, you're probably wondering, well, what happened after that 15th week back in 1972? Well, what happened was the market then traded sideways for something like about 7 months, and then it had another rallying period and made new highs. And you can go back and have a look at that period if you're interested. But I don't think there's much point in like calling it up and really analysing the 1972 period and then trying to use it as a template for the day, because every period is different. And what happened then, it's so unlikely that the same sequence will play out again. And I often see people get these comparison charts of the current price action wherever that may be, and overlay with previous periods, trying to use it as a map for what's going to happen. And I particularly saw it quite a bit during this decline during 2022. There were quite a few people putting up comparisons of the price action during the 22 period, or actually the 21 and 22 period, and then overlaying it with what we saw during the GFC. And it was around, I think it might have been around this point in January, or maybe it was a little bit earlier, where the GFC example had a very steep decline, and people were saying, look out, the big decline's coming. But as we know, nothing could have been further from the truth. It was the start of an upward period. So be very careful using comparisons to previous periods. But what we can take from it is that big rallies typically lead to consolidations, and I don't think this period that we're experiencing in the S&P 500 is going to be any different from that perspective. So that historical footnote aside, how's this shaping up now? How are things placed with the S&P 500 where it currently is? Well, volatility started to creep in this week. We saw the index at a new all-time high on Monday, and on Tuesday we got a decline of about 2%. Just looking at the chart as it stands at the moment, prices are still stretched above these moving averages. So I've got the 50 and the 100-day moving averages. So we had a bit of a headline making decline on Tuesday, but really didn't do much to getting back to these moving averages. And price action above the averages, it can persist for a while. It's normal, it happens. But the thing with the moving averages is that they're a little bit like gravity, in that at some point, prices always come back to test these moving averages. And of course, this time is going to be no different. I think the play here is to keep holding stocks in upward trends. This is what I've been saying for a while. We want to let our profits run. When stocks are working, let them run. And I think use a wide trailing stop. And the idea or the strategy behind a wide trailing stop is that should the market pull back to these averages, a wide trailing stop in your stocks can potentially see off a modest or even a moderate pullback, stay in the stock, stay in the market until the market potentially rises again. That's the idea behind those wide trailing stops. And I think that's the best way to keep the upside open in this sort of situation. We want to keep upside open because we never can be sure how far the market's going to run, but then we can also protect risk, and which is always such a critical thing to do, protecting your downside. I don't think this is a time where I'd really be adding new positions at an index level. from a risk reward perspective, the potential for a pullback towards these moving averages, I think it's just too high for my liking. I'd prefer to look for opportunities maybe from within the index rather than buying the index outright. And I'll show you why that is. So just looking at the S&P 500 equal weight ETF. So this is interesting. The equal weight made a new high on Thursday. It made a new high. The S&P 500 didn't. So I think this is possibly a sign that a developing broader rally could be starting to gain some traction, moving away from those top 7 stocks and then looking for stocks within, for in the equal weight, for instance. And from my own perspective, I'd rather buy the equal weight at a new 2-year high than chasing an extended S&P 500. The equal weight is still below its high from January 2022. I think that's a better risk return environment at the moment. It's not the only equal weight's not the only developing opportunity. I'm going to show you another one in a sec. But firstly, look, if you're getting some value from this, please hit that like button. Please leave us your comment. Just, hey, thanks for the video. Helps the channel a lot because YouTube sees people who are watching and engaging. It shows other people. That really helps me. So please do that. Now moving on to something else, which I think is interesting and being well worth being aware of. It's the small caps. This is the Russell 2000, and the small caps I think they're looking very interesting. The Russell's breaking above resistance at around 2000. You can see this resistance capped the market during 2022. It's starting to break above this resistance and is just a touch where it closed on Thursday. It's just a touch below a 1-year high, and that 1-year high would be from just a couple of months ago in December. Clears that, well, then it's going to be close to a 2-year high. So it really is getting at interesting levels. It's cycled from below the moving averages. So again, I'm using the 50 and the 100-day moving averages. So the Russell cycled from below the averages to above. It's pulled back. And had 2 retests of the 50-day moving average, being in January and February. And there's been buying activity on both occasions. And I think that's really important. It's really important because it's so different to what we've seen previously, where each rally was really a distribution event. There was no support when the market started to pull back. Now we're getting the support on the pullback. So it's quite a different technical situation. And I think the picture really has transitioned. The technical picture's transitioned from a declining or a bearish market to a neutral sideways market to now what we're seeing is potentially an emerging bull market. And with this big basing structure potentially in place, I think that this is potentially that early stages of a larger recovery. Could see this index back to its all-time high in the months ahead. Also, same goes for the iShares Microcap ETF. This is a really interesting one to have a look at. IWC is the ticker code. Very much the same situation as the Russell. Price action is a little bit different, but it's the same general setup where we've gone from below the averages to above. We've pulled back to the averages, and now we're starting to rebound off them. I think from a risk-reward perspective, these are the areas which I find the most interesting sectors of the market at present. So look, hopefully that's been interesting. Having said all that, I think we might leave that there. Hopefully that's been helpful. Give me that like if it has, and I look forward to coming back and talking to you next week. Until then, bye for now.